And when you look at the 2008 global meltdown, what do you think the causes of that were?
The causes are quite complex in my view, but there are some things that are one can easily point to. So first of all, I think that just on banks, for example, that we moved to a system through something called Basel II, which is set sort of among the G20 and other countries, which was really banks and other financial institutions self-administering their capital. And what that meant was, I think the assumption was their reputation, they would take care of themselves and their sustainability. But in fact, what it meant is that they didn't keep enough capital to keep their promises. And so what happened is when other markets froze, like the derivatives market, people started doing a run on the bank. And in fact, banks started to fail because they couldn't keep their promises to deposit holders. The second thing is the derivatives market itself. So derivatives started out, they're a very complex set of products.
And maybe you could start by explaining what a derivative is for people who may not fully comprehend that term.
So derivatives are actually a catch-all for a whole bunch of products, such as collateralized debt obligations, which are really where you bundle a bunch of mortgages and resell them in tranches to people, for credit default swaps, which are a product that was originally designed to manage risk, but became really subject to a highly speculative market instead. And securitization, which again is another form of, if you take a mortgage from your bank, the bank is going to give you that mortgage, but it's going to immediately bundle it and resell it to other investors. And so there's a whole set of forwards, swaps, warrants, et cetera, products. I think the point is, though, and I love Andrew Haldane, who's the former head of the Bank of England, said that to properly understand a collateralized debt obligation squared, you'd need about 1 billion pages of materials. So aren't all 1 billion pages, but I think it really talks about how the fact these products are highly complex.
So the CEOs themselves don't even understand the products.
CEOs don't understand them. The accountants and the lawyers will often tell you they don't quite understand them either. But their complexity means that they're sold in the market with the bottom line being that they're either high, medium, or low risk. They were poorly credit rated, in part because the way in which the credit rating agencies were structured and in terms of their incentive effects, in part because they had outdated tools.
When you say their incentive effects, you mean they're paid by the issuer?
They're paid by the person selling the product, and that's the structure globally. And so the incentives are to rate as highly as possible. So what happened is basically what started out as products that were AAA and AA for the most part in terms of their rating. They turned from risk management, which was their original goal, to being highly speculative. You had a bunch of new players in the market, so a lot of, for example, credit default swaps. They started out where the majority of the products, 60%, were done by the banks. Just before the financial crisis, the banks had really shed their investment, and distressed debt funds, or vulture funds as they're affectionately called, had moved into the market, and they were now putting a lot of pressure on to have higher risk, higher return products without necessarily telling the public that's what was happening. And they had very, very short-term profit incentives themselves because that's how they're rewarded. So the long and the short of it is you move from risk management to highly speculative, improperly rated, sold to lots of people who were told that their products were medium risk, when in fact they were very high risk. And then when the market froze and then collapsed, a lot of people that thought they were investing very safely in the market found out that they weren't. In Canada, although we didn't have as big a subprime meltdown as the US, we did have a meltdown in what was called the asset-backed commercial paper market. And originally it was thought, well, these are just sophisticated investors, but in fact there were more than 2,000 retirees caught in this. And if the government hadn't intervened to help bail them out, they would have lost collectively more than 20 million. But they were compensated through a workout with some of the big financiers, but many, many other small businesses, municipalities, and school boards got caught for 1 to 3 or 4 million because, again, they had been told they were safe and they weren't, and they just lost their investment.
How exposed were credit unions?
Credit unions, there's less public information about that, but I know that they were affected to a degree. It depends a lot on the credit union across Canada. If they were more fiscally conservative. It was likely that they weren't invested in the asset-backed commercial paper market. Where they encountered some problems, though, was that as the ripple effects happened in the system, people lost their jobs and lost their savings, their capacity to keep their mortgage was diminished. And so what they found was that a rate of defaults and foreclosures went up quite a bit.
So they were affected as well. We often hear our finance minister and the prime minister talk about how effective Canadian financial regulation is, and that's why we were able to avoid this terrible financial tsunami that struck the globe and wiped out all these banks, and aren't we great? I'm wondering what you think when you hear that. Did Canada do as good a job as we're led to believe by the politicians?
Well, I think we did some things right. In place were some pretty conservative liquidity and capital requirements, so that when I go back to what I mentioned about Basel II, is that its old standards at between 4 and 7%, we in Canada were requiring our banks to hold more than double that. So that was a really good thing. We have a program in place here, which is an early intervention program, so when it looks like there's a problem with the bank, before any of us hear about it, there are 5 stages of intervention. And we do know that, in fact, a lot of our banks hit stages 1 and 2, and the regulator intervened to actually help.
Those are the lower stages.
Those are the lower risk stages.
Yeah.
In other words, the first inkling there was a liquidity or capital problem, there was an intervention. And I think that helped us. And in fact, that early intervention's become a model and is being implemented in many countries globally. But it's not to say we weren't affected, and I think that's one thing that it's important for the public to understand. So, for example, our lending rates went up, and the capacity to borrow, especially for middle-sized and small businesses and for homeowners, went down. The cost of borrowing went up, and your ability to borrow went down considerably because our banks were affected by the interbank market. So what that means is the cost of credit is much higher than it used to be, is likely to be sustained for some time, and your ability to get a loan if you're a small business person in particular, but even mid-sized businesses, is much, much harder, and the banks and credit unions report this right across the board in Canada. So we are affected by that, and there's no question going forward we'll be affected because in Canada, for example, at the height of the crisis, because of these other issues, we lost on an annual basis up to 400,000 to 500,000 jobs, according to the Bank of Canada's estimate, that had direct linkages to the financial crisis. So we weren't unaffected. The other thing I would say is that during that period, people also ran their credit card debt up quite a bit. That was the bridging that they used. And I think we're going to see in the next couple of years quite a bit of financial distress by individuals and small businesses because of the high credit card debt. And that's something we also haven't, I think, come to grips with. People are turning to something called HELOCs, which are home equity loans, and they're consolidating their credit card debt, and they are taking out money on their mortgages. The problem with that is that with the decline in pension plans, most of us think of our equity in our homes as our economic security going into retirement. And if we are, in fact, using up our home equity much earlier, we're going to run into a big problem in the next 10 years as people start to become of age of retirement and don't have that cushion.
We're also seeing the proliferation of these payday loans, money marts, and things like that. Is that a manifestation of the high personal debt and credit card debt and things that we're seeing?
It absolutely is. So there's no question some issues around financial literacy. We all could know a lot more about interest rates, but that's only one part of it. Almost 1 million people with low income, not unemployed people, low income in Canada, don't have access to low cost or affordable bank services. And so they can't get loans, and so they tend to turn to the payday loan lenders. The problem with that is that legally in Canada, most of the provinces, not all, but most have enacted payday loan legislation. And they've actually set a cap of interest that's much higher than the criminal code rate.
Well, that's what I hear. It's usury if it's more than 60% per annum, but these companies can charge more than 60%
in a number
on
of
an annual
provinces,
basis.
up to 460%. And yet most people who are taking payday loans out, heavily in the older population, youth under age 30, and in the immigrant population, is that they don't understand that they're in fact on a treadmill of payday loans where the interest is much, much higher than even expensive finance companies.
How concerned are you for the state of the Canadian financial system when you look at the problems in Greece, Portugal, Italy, Ireland, Spain, these European countries with very, very high debt levels? Could it have a big effect on our savings and on our retirements?
It's a good question. It's a complicated question, I think. We're affected directly by them because of our banks in the interbank market. There's no question. We're also affected because, of course, the countries that are a little better off are being asked to help the countries that aren't. And our banking systems and our financial systems are so integrated that it's very hard to actually refuse that. But I think in the long term, yes, we're affected by the cost of credit and the availability of credit in Canada. And I think that we're not out of the woods in terms of what it means for us going forward. Quite aside from those countries, though, in terms of our credit card debt, we're one of the 2 or 3 highest in the globe.
Really?
On a per capita basis.
Do you know what our credit card debt is on a per capita basis?
I don't have that figure off the top of my head, but there's no question that by the point at which people are in financial distress, they're often looking at anywhere from $30,000 to $50,000 in credit card debt. But I don't have it right at the tip of my fingers.
And my final question is, you're obviously very passionate about this subject. To some it might strike them as arcane and challenging and difficult and very intellectual. Where does the passion for financial regulation come from?
I think it came from wanting to know more myself, wanting to understand the complexity of a number of the products that are in the market, and also wanting to try and make it more accessible for people. So trying to even explain to professionals, accountants and lawyers and scholars, but more importantly a broader public, that these are issues that are complex, but nevertheless we can understand them. And then in turn, if we can understand them, we might change our own individual practices somewhat. And I think equally important, we might try to enter into a discussion, a public policy discussion with the government, with all our governments, about things that could be done a little differently in order to protect all of us in the long term. So the passion probably comes from that.
I said that was my last question, but I have one more question. What advice do you have for policymakers to prevent frauds and rip-offs in Canada? If there's 1 or 2 things that could be done either at the provincial or federal level, what would you say?
I would say really ramp up, the commitment to it, the resources and the skills to do it. And that would be the big thing, really. I think that's incredibly important, even beyond fraud, just to really, really scale up the protection of investors, including, frankly, I would impose a standard that financial advisors should act in the best interest of their clients. Lawyers have that obligation, accountants have that obligation, teachers have that obligation. I don't know why financial advisors shouldn't have that obligation.
Okay, thank you very much, Janis.
Thank you.